2, 1. Hey guys, welcome back. You already know Billionaire Acquisition Mastermind, #1 channel, podcast group in the world. That's a fact. We got over here Chris. Chris Nix, if you can introduce yourself, please.
Hi, it's Chris, Managing Director with LCG Advisors, a lower middle market transaction advisory firm, and I head up and started the quality of earnings / acquisition due diligence group at the firm.
Great. Ansi, your little intro.
You already know it's me, y'all. Yeah. Can you guys hear me?
Yeah. All right, let's see. Let's get the action in.
Let's go.
Let me tell everybody.
Let's go.
Tell everybody to start commenting. Everybody comment Billionaire.
Appreciate you being able to make it, friend. Yeah, let's get it going, man. Let's get it going.
All right, Chris. So let me ask you, starting 2021, how have you seen, the environment so far in M&A? Does everything look way better than 2020? Are the dark days behind us, or are we still in the clouds? You tell me, Chris.
I don't know. We'll see. Time will tell, right? But so far, so good. I mean, this is the hottest beginning to a year I've ever had. Normally, things come out of the gate a little slow, but we're rocking and rolling so far. So
great.
Hope it keeps up.
Absolutely. Okay, let me just fix the audio. Hey guys, everybody, just comment real quick if you could hear as well. Okay. Perfect. So, Chris, if you don't mind me asking, what's your deal range? What do you specialize on? What type of transactions? Deal size?
It's a little bit of a broad range, but I mean, we do everything from, cash burning software deals to, I guess on the high end, probably $15 to $20 million of EBITDA. It's across a range of industries, healthcare, food and beverage, heavy manufacturing, lots of business services.
Right.
Again, software and tech, you name it. We don't do much in real estate or oil and gas, but otherwise we're pretty focused. Our main specialty is family and founder owned companies.
Right.
And dealing with the kind of the complexities that come in the lower middle market there.
Great. Hey, Ansi, do me a favor, drop the link on Facebook. Make sure everybody's hopping in. We got everybody in. We need everybody to hear Chris and his wisdom, all his years of expertise. How many years of experience do you have, Chris? How long have you been doing this for?
I've been heading up the group here for about 7 years. Got about 10 years of overall kind of professional services experience. And in the kind of accounting and finance realm.
Great. So we got another financial wizard, guys. I'm telling you, Chris, the amount of guys that know how to evaluate a company properly, they're few. All right, but when you find them, they're gold, so you want to keep them. Now,
I sure hope so.
What industries have you seen that are the hottest right now? I've heard about HVAC. They say home health's coming back. Let me hear your insights.
Home health has been pretty hot for a while now. The multiples have been ridiculous there for a while, as long as I can see. HVAC, anything else that's kind of both home and facility, like maintenance services, because they tend to be kind of sticky. The last couple of years, those have been pretty hot. We're seeing a lot in facility services. Most private equity buyers prefer something in like more of a business to business focus as opposed to any kind of retail concept. Yeah. So, you can get in there. It's pretty recession proof because people need to have their buildings maintained no matter what, it's like having electricity, right? You can't be a grocery store or a retail store and have the lights turned off. You can't show up with sticky floors or anything else like that. So, I think people have been kind of planning for a recession for the last couple of years. So anything that's got a little bit of a recession-proof or counter-cyclical aspect to it has been pretty hot.
Right. Now, let me ask you this, Chris. We're currently in a pandemic, right? This is different from a recession. People have been talking about there could be a recession coming in. What are your insights regarding that? What do you think?
We're in a recession. It's just a matter of how we come out of it, right? It's pandemic driven, so it's a lot different from what anybody else expected.
Right.
But I mean, anything in hospitality has absolutely gotten crushed, but everything else is doing pretty well for the most part. Depending on the industry, you see some things that took a nosedive for a couple months last year, and other things that skyrocketed for a couple months, then came back to earth, and kind of everything in between. But I mean, for the most part, the whole K-shaped recovery thing that everybody talks about, it's real. It's affected some industries and sectors, and the rest of them have kind of kept on chugging.
Yeah, it's crazy. Now, let me ask you this. We've had the government issue out PPP loans, all type of support, SBA. Are these, would you say they're more of a short-term solution for a long-term problem, or have they actually helped out these businesses recover and like pick back up?
Depends what side of the fence you're on, right? So again, if you're in the hospitality sector or something along those lines, I mean, probably not enough has been done. If you're, someone in an industry that, didn't really get affected, then it's just gravy for you. And, it's the ones sitting in the fence that are in the middle that are, kind of got different answers there. But, almost every company I look at has taken a PPP loan of some sort. And, some of them desperately needed it, and that's what kept the lights on. And, others have been able to kind of clean up the balance sheet a little bit with it too.
Correct. So one thing I want to understand regarding PPP loans, we're coming in to buy these businesses. If we're buying the legal entity, do we have to pay that back? I've heard there's ones where the government will forgive the loan, but if that's not the case, do we have to pay that, or the seller has to cover that?
Well, I mean, almost all of these things are getting forgiven. It's really just a matter of how you protect yourself to make sure that you're not going to get stuck with it if for some reason they don't get forgiven.
Right.
So in reality, I don't expect many of these to get paid back.
I see. Now, let me ask you this. I've heard about if you were to buy a distressed business or a business that's going down and you're a new owner, you could get a PPP2 loan or some sort of type that you could use as working capital, essentially, to pump in the business, get it back going. Is that correct?
Yeah, I mean, in reality, that's what most of them are really doing, right? Is it's kind of all around working capital. They are saving jobs, but some more people are starting to see them as just a boost to working capital, whether needed or doing a little cleanup of some issues that was already there before.
Right. Hey guys, real quick, comment your questions. You got any questions you want to ask Chris? Take advantage of the time he's given us, and get the questions rolling. Overall, Chris, I've read in this report that we're talking about business evaluations more in the lower middle market, and they were saying the majority of purchases in small businesses are asset sales. Is that correct?
Yeah. There's just, in most cases, there's no reason to do a stock sale. And, in healthcare, it's a little bit different if there's some sort of licenses or something you're trying to transfer over. Certain other things like that in different industries, but most of the time, it's all you're doing in a stock sale is transferring over potential liabilities to the buyer. So, correct. And it just gets messy.
So, okay, let me ask you this. Let's dig a little deeper into that. Now, in regards to businesses that do require licenses, would we be obligated to have to do a stock purchase, or is there a way around that?
You're not obligated, but it's a lot harder. I mean, most of the time, well, depending on the industries, but I've seen it a lot, especially like in home health, right? Where, a lot of times what you're buying is a license because, there's a finite number of them, and so those are usually attached to a legal entity. It's like trying to buy liquor licenses in New Jersey, right? There's only so many of them to go around. So, you want to take, that's really what you're going for. Sometimes you're not even making money and you're buying it just because they happen to have that one license.
Okay, I want to know this. Do you need a license per every business you buy if it's the same type? Let's say if you're doing a roll-up, or can you use one license to operate them all?
Depends on the industry. Some of them are issued on like a county by county basis. So
I see.
And depends on the state, depends on, there's a lot of factors that go in there. So you got to look at the sector, the industry, and what state you're doing business in.
Right. So let's assume we're buying, I don't know, a hospital in California or a physician office, and we need that license to operate it and is allowed statewide. Would you, and let me give you an example, and you tell me if this would be a good approach. From what I know, there's a risk to growth factor involved with businesses. So essentially, the lower risk they take, the slower they grow. There's a reason there's small businesses and they're stuck in that range. So if we're able to acquire a small business where they don't have any current legal liabilities or financial liabilities, I'd say between the $1 to $5 million range revenue, they're pretty clean overall. Could it be wise to acquire the stock, take the license, wet and then just buy assets to operate under it?
Yeah, under that scenario, I think that makes a lot of sense. I mean, as long as there's no, legal hurdles or whatever to, needing additional licenses or anything, then, might as well. I mean, I guess the first thing I would look at is how hard it is just to get a license.
Right.
In that state, can you just go ahead and do an asset sale of something and either, find a way to transfer the license or to set up a new one?
Yes.
A lot of times, again, where the value is if that's an actual barrier to entry in that state or not. If it's not, then you're generally going to be better off trying to start something new or to do an asset purchase. But
right,
if there actually is a barrier to entry with those licenses, then you want to go for it.
Yeah. Now, I see asset purchase. It makes more sense when it comes to things that are in the tech space, as it's just intellectual property. You can move it around. But when it comes to brick and mortar, buying assets from hospitals, doesn't it not make sense? Because, okay, you buy the assets, the tools, the equipment, the client list, the vendor list, but now you don't have the hospital. Like, where do you operate? From a warehouse? Or would you have to, transfer everything to another physical location? How does that work?
No, I mean, in an asset sale, you can still carry on the operations exactly as they were before. So, all contract, you just got to look at the contracts. Are they assignable? Okay. Or in the case of the ones that aren't, can you get a new one in place?
Right.
So
if I'm correct,
value is in all the contracts and the relationships and everything, and that can be customer, vendor, and kind of everything in between.
Right. Okay. Let me ask you this: if we're acquiring a business and there's high customer concentration, at what point does that become a potential or future liability? Anything over 10% or more?
It's hard to put a number to that. I mean, depends on the industry and depends on how sticky the customers are, right? I mean, concentration is only an issue if you have a big risk of that concentration going away.
I see. But due to the possibility of it, can you use that to deduct or basically a smaller purchase price in regards to that? Because I've seen where people talk about the value of the business is usually the cash flow divided by the business risk or the acquisition risk, something in those terms.
Yeah, I mean, there's two ways to look at it, right? One is purchase price, and the other one's structure. So,
correct.
And those are different levers you can pull. I mean, you can either try to use that to reduce the purchase price, or you can say, hey, look, I want to put more in an earnout. And they got to prove it out for X number of years for them to get paid. Or there's other things you can do too, but it's just the two simplest ways.
Let's talk a little about earnouts. Do they make sense on paper, or do they complicate the deal more than necessary?
All depends on how well educated the buyer or the seller is, or how well educated you make the seller. One of the two.
Right.
I mean, it's never as easy as paying everything up front, right? But take a lot of risk off the table, especially if there is risk on the table to start with.
Yeah. Let's talk about seller finance. In regards to seller finance, it's great because not only are you financing a smaller portion, smaller LTV on the bank side, the commercial debt, if you could come to a good agreement, you could structure it over 7-10 years at a lower interest rate. But I've heard where you can enforce reps and warranties on that seller finance portion, where, for example, if there's anything that pops up, any skeletons in the closet or any things that we were not noticed of, we could deduct his holding equity or not pay at all if we enforce it. Is that correct? Or how do you go about that?
Yeah, you can do anything. It's all what you draw up on paper, right? But anytime you've got some money that you're holding back beyond the initial purchase, it's going to make it a lot easier as far as reps and warrants go.
Great. Now, from the deals you currently analyze, what do you see as the most common structure? Is it the LBO model? Is it distressed businesses? What is usually coming through your table a lot?
Oh, it's all over the place. We see it all. We're mostly working with somebody that's more institutional investor, some kind of private equity, but that could be a traditional fundless sponsor, or independent sponsor, whatever you want to call it, search funds, family offices. We're kind of all over the place. We're not an accounting firm. So, like a lot of the accounting firms send more corporate buy side clients or more sell side deals that they pull from their audit or tax practices. But, because of that, we tend to go straight more to the institutional, but it's all over the place. We've got clients that do nothing but distressed deals. We see a lot of corporate carve outs. Yeah. But then, we also see a lot of straight, LBOs and then, all the roll up strategies that happen from there as well.
Right. Let me ask you this. What are your insights regarding roll ups? From what I know, it's not the numbers that break the deal or the roll up, but the culture clash in essence. Because you're not acquiring just 18 businesses, you're rolling them up, merging them to be one big business. So how do you see the completion rate in regards to those?
Yeah, look, they happen a lot as far as the actual acquisition. Now, what you do with it afterwards varies, but it's harder to assign a number to that, right? But I think more over the years and in recent history, people have spent a lot more time looking at the culture of the firms that are being put together, and realizing that there's some soft pieces to it too. It's not just dollars and cents in a model.
Right. Do you see the future? Is this going to be the new normal of working from home or not being in an office, basically remote work?
I think you're going to see more of it, right? Mm-hmm. But part of it depends on where you live. Frankly, I think different parts of the country have responded differently already, and I think those places that have probably spent more time working from home than others are probably going to stay that way a little bit more so, right?
Yeah.
And I can tell you, in my business, we were already doing more remote work before the pandemic. Right. I'd say like when I first started doing this 7 years ago, or first started at LCG 7 years ago, started this group here. Yeah. I did by far the vast majority of our deals, we had an on-site component. Mm-hmm. And pre-pandemic, it was probably more like 50-50 as to whether we went on-site at all. And now obviously we've been basically 100% not going on site for the last year. So, I think we were already trending in that direction anyways. And I think it's just a little microcosm of the overall macro environment. So I think there's going to be a lot more of that.
So in regards to, the new government with Biden coming into play, talking about corporate taxes going up to 28%, if I'm correct, capital gain tax is going higher. How do you see that affecting small businesses?
Depends on what actually happens. Part of it is what happens, and part of what is what people perceive as happening, right? Right. So nobody really knows. He's got a plan that he put out there. Mm-hmm. But and he's got a slim majority in the House and a barely majority in the Senate. So there's got to be a lot of gamesmanship in there. So I'm no political expert, but I'd be surprised if he is able to push through everything that he proposed. Yeah, and and then I think the fear is what could drive a lot of people. So I wouldn't be surprised if, we just got through the Georgia runoffs, 2 weeks ago or something. I wouldn't be surprised if, a lot of business owners are now saying kind of, oh man, all right, I didn't think that was going to happen. We need to start thinking about selling because, I think we can get through this year without a tax change, but we might not get through next year.
Oh, I see.
so, but there's a process, right? I mean, you hire an investment banker, and then, it takes a couple months to get everything out in the market. And then, and then there's a whole deal process beyond that. I mean,
right.
Look, so my firm, we own a broker dealer.
Mm-hmm.
We have an investment bank. So we're kind of looking at it like, all right, game on. And in regards to that, but, so we're kind of excited, and even from my side too, on the quality of the earnings side, but time will tell. I think that we're going to see the market heat up even more here soon because of that.
I see, but for the time being, we're looking at what, business as usual?
I mean, what's business as usual right now? I don't think anybody really knows what the heck that is right now.
We're in a world of chaos. Yeah, we can't even set a bar, a standard now. Now, let me ask you this: when these guys look to do changes in the policy, I suppose they consult with experts, right? Financial experts.
Yeah. I mean, there's a ton of financial experts out there, though, and they all have different opinions. It's not, it's like anything else. You can say follow the science or follow the experts or whatever, but there's
right.
They're a dime a dozen. They all, you pull 12 people aside and they have 12 different opinions, right? So
correct. Yeah, because I see you're looking at things on a macro picture alongside micro. You got to compare two and balance. But let me ask you this: they're talking about setting a standard of $15 an hour minimum wage. If that were to occur, and we're looking at acquiring, let's say, a small business, 5 million revenue, and employees are getting $12 an hour, would we want to basically analyze, do the analysis on, the amount of employees we have and bring everybody up to 15, whoever's getting paid under it, and then add that into payroll, basically deduct that from free cash flow, because that could be a future thing that is not going to be free cash flow, essentially?
Yeah, 100%.
Yeah?
I mean, yeah.
Okay.
Yeah, I mean, anything that it's coming down the pipeline, you should always factor that in, right?
Right. So when you do a quality of earnings report, what are the things you look at from a superficial level before you even start digging deeper? How do you tell if this deal's worth even, wasting your time on or spending any time on?
General kind of quality of the financials. And even then it's not as easy to say, okay, don't spend any time on it, but hey, there's some red flags here. And, these are the things we probably want to look at. You see enough of these and you start to just kind of see, you're able to see the red flags pretty quickly.
Right.
And it varies. I can't say you got to look for this one thing or whatever, but I guess one thing is that you always have to be wary of is if it's real ad back heavy, and then you got to look at the nature of those ad backs. And if it's all just owner personal expenses, they've got their personal airplane or whatever on the books, and it's pretty easily quantifiable. That's the thing. But if they're saying I could really do without these 10 people and whatever. Well, yeah, but can you? How do I know? So I mean, that kind of, that's the one thing I could throw out there that is kind of a gimme of a red flag. Otherwise, there's a lot of gray area out there.
Yeah, absolutely. Now, in regards to what I want to know is when it comes to personal expenses for business owners. So, Ansi here was looking at a deal where there was about $500,000 in, what was it, travel and entertainment. Is that considered an ad back? You take it off because it's not something you're going to keep on spending once you purchase the business. Would you add that back to a cash flow?
Yeah,
how do you verify that?
Yeah, I mean, you got to look at it and you got to talk through it with them, and then and it gets a little squishy as to exactly what you do there, right? But you got to understand the nature of it. Is there anything remotely client related? Because if so, I mean, I've seen guys, they take the clients on a fishing trip and say, well, it was really more of a personal expense. Mm-hmm. Okay, but the clients expect that, and that's, is that part of the generation of revenue?
Right.
You gotta dig into it a little bit there, or is it you can see the 3 plane tickets, for the owner and their spouse and their kid, all in their name, going to Paris, and all the business they do is Mississippi. Like, okay, well, obviously that wasn't work related.
Right. So let me ask you this: if you were to do, okay, let's talk about bankruptcies real quick. For business has had, let's say, a bankruptcy 2020. They had a bankruptcy of about $1 million, and they're still working through that. Would you just trash that deal? Does it make sense, or how could you go about it?
I mean, I guess it depends on where you're in there. I mean, are you part of the auction process? I mean, if so, then are you getting into stalking horse position, or are you part of the broader auction? Or is it like, otherwise, right. Yeah, if that's the case, yeah, I mean, go for it. You might be able to get a steal. But otherwise, I mean, you don't want to try to put in some money into something that you have no idea where it's actually going.
Right. I want to, yeah, that makes sense. So I want to ask you, man, I just got so many questions. When it comes to the purchase of the business and they got a bankruptcy, okay, let's use this as an example. Let's say we got 3 businesses and 3 hospitals, and we're doing about $10 million between them all. We got $2 million net cash flow at the end of the year that we could use to reinvest or whatever. And there's some other hospitals within the area that have gone bust, or they're distressed, or had a bankruptcy. They're in the negative essentially. Could we acquire the assets and just defer all the liability and take that? See it as an opportunity?
I mean, you got to look. I mean, that's got part of the negotiation with the creditors, right? First and foremost is you got to figure out, they're trying to get some of their money back. So, I don't know if you can get out of all the liability, but you got to look at, what they're willing to accept and how that can be structured. And then what's the underlying reasons why the business folded? Is it just poor management? Did they just have a completely upside down balance sheet, or was there some fundamental reason why, like in that case, it's bad location,
right.
Inadequate facilities, something like where you're going to pour a bunch of money into it, or it's just never going to work. I mean,
correct.
There's a lot of soft stuff there.
There's a hot topic everybody wants to know about: forced takeovers. How do you go about one? I've heard you'd go to a bank, and let's say the business, you figure out this business is using this bank, and you'd go in, and if you could build some chemistry with the guy or the banker, be able to have him show you his books in regards to the debt. Could you purchase that debt and go and essentially tell the guy, hey, I'm looking to collect on this money? Or how would you go about that? Have you seen any of those? Have you gone through any of those?
I mean, you don't really see the forced takeovers in the lower middle market so much. If the bank is going to, and I think doing it like that, where it's a private sale. I mean, if the bank has, I guess maybe some smaller banks or something, you maybe find those, but they're not usually going to be lending to companies that are worthwhile most of the time either. So, because you've got like your loan to own banks where they go in, with teams in there that like they kind of expect that a certain number of their companies are going to tank and they're going to take over it as, in the equity position. And then, then you've got your regular commercial banks where, they'll put in a special assets and they monitor the heck out of it. And then, but then if they got it liquidated, they're just putting it through a process because they don't want to actually own these companies. And then it's going to go out in an auction probably, right? Because they got to report to their shareholders that they did the right thing and probably don't want to just completely hand the keys over to people. Now, that being said, I mean, I've seen other arrangements and stuff. I mean, anything can happen, right? But right, it's not seen a lot of, at least.
I see. Now let's start running through the questions people have commented about. Alex asks, what kind of industries do you think are the best considering the pandemic?
Man, that's a loaded question. I mean, what industries are the best right now, or what industries are going to be the best going forward, right?
Going forward, I see. What's something we could buy into now and not have to worry too much about in the future?
Yeah. Well, I mean, anything you don't have to worry about too much isn't going to have, you're going to have to pay up for, right? So that's part of the problems.
Right.
I mean, look, I think all conventions have been turned upside down a little bit here. If I had the golden ticket for that, I'd be, buying that.
Diaz asks, at what point is the deal so big that the process for due diligence becomes more complicated? At what different levels of due diligence complexity exists overall?
First off, I guess there's not a size range where the diligence can be complicated. Sometimes the bigger companies are almost easier to diligence than the smaller companies, just because sometimes they'll buttoned up, and you can have what seems like a relatively small and simple family business that the books are just and it ends up being way more complicated. So I'd say size is irrelevant, and then from types of diligence you can do. I'd say the one thing we always suggest to our clients doing is starting with what we call a cash proof. And that's where you kind of go and we take all the bank statements on a monthly basis for the last 2 to 3 years normally, and compare them to all the financials that have been presented. So you take deposits in the bank statements, compare them to income and the financials, and then same thing, withdrawals and expenses. Reconcile them out separately, reconciling for non-cash items, changes in the balance sheet, any other kind of funky accounting going on or whatever else. And that way you can kind of prove out that there's actual economic substance behind what's going on in the financials, and that you can at least have some semblance of reliance on them without going through a full, auditing every transaction kind of thing, which would just be super time consuming, expensive, and probably not value added. And then from there, you start adding on, so, looking at validating managements, add backs and deductions, if they usually just add backs. And, doing income statement analysis, working capital analysis, ratio analysis, customer and vendor analysis, looking at the concentrations, things like that. Sometimes we'll get into analytics on different revenue lines, looking at margins by line of business. Some of it depends on the industry too, but you can dive into a lot of different things. And so, but it's like New Orleans cooking. First, you start with a roux. I kind of always recommend people to start with kind of the proof of cash, and then kind of work up from there.
Right. So, how does a quality of earnings report differ from a due diligence?
Quality of earnings is somewhat of a colloquial term. It is a form of due diligence. I mean, there's different kinds of due diligence, right? So, I mean, there's vendor diligence, customer diligence, HR diligence, whatever. Quality of earnings is financial diligence, but the primary function of it is to look at the earnings of the company in historic periods, and then get them up to a pro forma standard to where you can say that those are actually still representative of what you would expect to have in the company after you acquire it.
Right. So, okay, let me ask you this. In regards to pro forma, when it comes to a purchase of a company, a lot of business owners like to take into account the future of it, saying, oh, we could double it or we could triple it. Or if you do more marketing, would you make an offer on pro forma, or we're just making offers on what's current, what we know is a fact?
No, only what you have, because that's like saying here, I can give this to you and you can go and work and make this happen. I mean, I'm not going to pay you for what.
Right.
I'm paying you for what you did. So
currently is, right? You're buying it as is. That's what you make your offer on.
I mean, that's been teed up or whatever, and you say, okay, look, if you want to stick around for a couple of years, and if this is going to happen immediately, I'll maybe kick you something, and contingently in an earnout or whatever. But you've got to make it happen. I'm like, it can't be me, otherwise I'm not paying you for it.
Right. Dia said it was an earnout.
Earnout is basically anything where you're putting part of the purchase price on them earning it out over time after the acquisition. So basically, there's a part of the purchase price that that is contingent upon future earnings, not just historical earnings.
Right. Chrome said with QSBS, when selling a C Corp, you can get up to $10 million per shareholder, up to $50 million total, tax-free upon the sale of the business. No capital gains tax. No capital gains tax. Isn't that worth it? Is that true, first of all?
First, I'm a CPA, but I'm definitely not a tax expert. There's some benefits to corporate structure from a tax standpoint, especially right now. The C corps have gained some benefits that above LLCs in certain aspects that they didn't have before the last tax act was put in.
Yeah.
However, no telling how long that's going to be around. So,
right.
Like we talked about earlier, the whole tax world could change, any day now.
Right.
Depending on, who's in office in Congress and how long everybody's in there.
Chrome asked as well, do you see inflation playing into acquisitions? And what would you do to counter or use it to your advantage?
Well, I'd say that, I think that's probably more of a macro and possibly even a global mechanism. When you start talking about inflation and, some of the other things that are a little larger like that, right. I think that tends to play in a little bit more when you're playing on a global stage. Frankly, that's not really where, my firm and my clients focus. We tend to be working on domestic targeted acquisitions. So
right.
I'm sure that there's a way to game all that, but that's above my pay grade.
Yeah. Chrome asked again, what tax advantages you see between C Corps and S Corps?
I think first of all, it depends on the state somewhat. Some states, in S Corp, you don't get the corporate income taxes, and others you do. There are some different advantages you can have as an owner and how you get your wages and how that gets, how you get taxed on those. Beyond that, I don't know if I'm smart enough for that question. I'm sure there are other nuances to it too, but I think that's about the extent of what I can probably share on the matter.
Right. So in regards to incorporating, what do you see as the best structure? Would you say an LLC?
I would say vast majority of what I see is structured as LLCs, just because they're flexible. There's a lot you can do with them. You're not as subject to the whims of taxation policy changes. Right. And again, there's a lot more you can do with them. I have seen some clients that, especially like independent sponsors, where they've started putting things more in C Corps in recent years since the last tax law change. So again, that's kind of dependent on that. Yeah. The one thing advantage you really have with that is that all the income that is not flowing through to the investors is not taxable, right? Yeah. Because it's only taxable when they sell their shares. Or, so in other words, there's an exit event. So, that can be appealing there. It doesn't really work in a traditional fund structure, but it does work on an independent sponsor deal a little bit better when you're raising funds on a deal by deal basis.
Right. Now, let me ask you in regards to e-commerce, how greatly does that differ from brick and mortar? Like the way you guys analyze or evaluate, especially the quality of earnings, because isn't there more volatility due to it being purchase by purchase instead of long-term contracts, or more risk?
Retail doesn't have long-term contracts either, right? So brick and mortar retail. That's kind of the risk of a retail period versus business. Anytime you're dealing with consumer-facing companies, there's a whole different set of risks that come into play there. So you got to feel comfortable with that side of it. But then, beyond that, when you're talking e-commerce, not to oversimplify it, but from what I've seen, there's two separate worlds in e-commerce right now. There's Amazon sellers, and then there's everybody else, traditional straight to consumer sellers, and or even going through other websites. If you're going through Amazon, that's a whole different ball game and set of things that you have to worry about there.
I see. Now, thank you very much, Brad. Let's finish off with, let me just share with you, a majority of the people in the group, they're working on their first round of deals. Others are looking to acquire more businesses. But for the most part, they would fall in the category of an independent sponsor. So what services does your firm provide for independent sponsors, essentially?
Yeah, look, for the most part, we don't differentiate between, any form of private equity. There's some different, we try to put ourselves in our client's shoes a little bit more. And so sometimes it's just looking at things from their perspective. We work with a lot of independent sponsors, and we understand, I guess kind of the dynamics of, them having to go and raise funds and them having to report to several different set of investors. And, I think one thing where our firm has a little bit of a competitive advantage is we tend to be a lot more, one, we do this a lot, but also because of that, we tend to be a lot more efficient. So, when you're an independent sponsor, if you're trying to bring in, the different levels of capital throughout the course of the deal in the same kind of time frame that somebody with a committed fund is doing, in order for you to stay competitive from that aspect, you need professional services firms that are working for you in the deal process that can get things done quickly. And I think that's one place that we've differentiated ourselves a little bit.
Now, let me ask you this: for somebody to bring you a deal for you guys to start analyzing, would that be at a post LOI stage?
Doesn't have to be, but that's normally where it is. Hey, look, we're a professional services firm. If you're willing to pay us, we're willing to do it, right? So, most of the time it doesn't make sense until you're past LOI, but we have time where we go in, especially, I haven't seen as much post-pandemic, but pre-pandemic, the deal market was getting so competitive. Where everybody was trying to find different ways to differentiate themselves, the buyers, that is. And so sometimes, they were wanting to bring us in to do at least some light diligence work, but pre-LOI, just so that they could kind of, show face to the sellers, be like, look, this is how, invested we are in this deal, that we want to invest some of our money and time and effort, above and beyond our competitors in the deal. And then also, sometimes, especially with some of our, established clients, they bring us in at times pre-LOI to help them negotiate like the net working capital target, or to make sure that they kind of know what they're actually bidding on. We do a lot of education of to sellers around net working capital pegs and what those mean, because most family and founder-owned business owners don't really understand what the heck a net working capital peg is, or why it exists, or why they've got to give up their AR, or, all these things that go along with that. And, we've actually written up kind of a Q&A document for sellers that, we've let our clients share with them, and we'll hop on the phone with them and help explain things to them. And so there's some different ways that, we try to add value to different parts of the process, but long-winded, it's super long answer, I know, but
let me ask you this: is there any free resources you could share with the people?
Yeah, anybody that wants to reach out, happy to help.
Great. So, Ansi, any last comments, questions?
Yeah. So, real quick, Chris, if you don't mind, to the extent that you can, could you describe like the kind of like the last deal that you kind of did a QoE on, so we can get an idea. I know it's every deal is different. The time varies, and it depends on how extensive the we want the QoE to be. Some want it more extensive, some want it less extensive. So if you could just give us a little bit of insight of what that looked like, kind of like something you're working on right now. No specific numbers, of course, but just what does that look like, so we can get a better idea.
Without numbers, I'd say most of the time, we try to price things in a range, a fairly tight range. And sometimes we even just go full on fixed bid. But even when we quote a range, we put the onus on ourselves to not throw a bad quote out there. And so we will never go above the top end of whatever range we throw out there without some prior agreed upon change in scope. And that way you're not worried about getting a surprise bill.
Yeah, perfect. So most of us are, again, lower middle market. So how long does it take for you to close or for you to have a report done on a deal that size, 1 to 10 million?
Yeah, I mean, really any size, right? We tend to have about a 2 to 3 week turnaround time, assuming the information flow is pretty good. And that'd be from the time that the data flow really kicks off until we issue a report.
Perfect. So are you able to take that QoE to other financial institutions, bank lenders and stuff like that to be able to, help our chances with the financing?
Yeah, that's what happens. Almost every deal, our reports are getting shown to the capital providers, behind our initial set of capital providers, and we end up on the phone with lenders, with other equity groups, very often. And one thing, because we're out in the market a lot, a lot of the other equity groups out there are familiar with us. If you're bringing in other equity. Same thing with a lot of the credit providers, even from a QoE standpoint, but also our firm. One of the original groups in the firm when we started back in 2003 was a lender's diligence group, where we actually perform collateral exams and other sorts of financial diligence for lenders out in the space. And we're in the top 3 in the nation now in that. So we're already on the approved vendors list for almost every lender that you can think of.
Great.
Perfect. So one more thing. How likely is it to get financing without a QoE from any firm?
Depends on the size deal and what kind of financing you're putting in behind you. But I'd say most of the time, not very likely. I mean, most lenders are going to require it. And if you haven't gotten one already, they're going to tell you to go get one, or they're going to get one themselves.
So do you see with you say you deal with a lot of private equities. When the deals, I'm not sure if you're around for this phase, but when the deal's ready to go through financing and everything, does the bank require the firm to have a CFO and the in-house accountant sign off on that deal?
Sorry, the CFO and the in-house accountant of the
seller of that company. No, the buyer.
Oh,
so they're basically their CFO and in-house accountant. Does the bank require them to sign
sign
off on the deal
situation?
Mm-hmm.
No, I've never been asked. I mean, I think normally if you own that company, though, you want your CFO to sign off on it because you want their buy-in, right? But so I mean, that's more of a thing than I think a capital requirement.
Okay, so some individuals they have a complete board, the CFO and all that stuff, and some have more or less a deal-making team. Not a complete, not a board per se, but just maybe a M&A banker, accountant, a couple industry experts. So is that a CFO? Is that something that's absolutely required to get a deal done? What I'm saying is, does the bank? Okay. So the bank is not going to say, "Hey, we need your CFO to sign off on that." So if you don't have any of that, they're not going to require that.
No, I mean, look, banks want to know that they're going to have their debt service covered. I mean, they've got some collateral to fall back on. I mean, those are ultimately the two biggest things. I mean, they just got to get it through their own investment committees.
So when I make an acquisition, let's say I'm in Florida and I make an acquisition in, I don't know, Kansas. Typically they say, "Hey, who's going to operate the business?" That being said, can we have, is it absolutely necessary that majority shareholder or equity holder of the company be there at that specific location? Or is the lender or bank okay with having an operator, right, a COO, operate that business irrespective of where they are?
Yeah, I mean, most of what we work on, the owners are across the country from whatever business it is.
Do you see a lot of acquisitions being made without the buyer walking the facility? If so, do you see deals going south more so because we're not individuals are not walking the deals, or does that not affect it at all?
No, I'd say I still see my clients going and meeting the management team and walking the facility and meeting with the management team before they actually buy the business.
I mean, a Zoom call wouldn't suffice, right? You'd actually want to see exactly the operations and stuff like that day to day, how it's being ran, right?
Depends on the industry. I think, I've seen a handful of times in the last year where, some very heavy, long, and extensive Zoom calls have supplanted, the kind of traditional tour. And that's usually in the case where there isn't much to see, right? I mean, like if you got a small service business where it's just, a handful of people in the back office or something that's really in the actual physical office, there's not much to see there anyway. So part of it can be circumstantial.
Okay, perfect. Go ahead, Valentino.
Chris, can you share with the people what firm you're working with and what's your position again?
Yeah, LCG Advisors. We're based out of Tampa, Florida, but we have employees across the country, border to border and coast to coast. And my position is Managing Director of Transaction Advisory Services.
You heard him, guys. Share, Chris, Managing Director at what? LPG?
LCG.
LCP.
LCG.
LCG. Everybody tell him thank you. Comment it and just tell him thank you. Hey, real quick, Chris, before we let you go, a last question. Somebody asked, do you have post-transaction services, bookkeeping, fractional CFO?
Yeah, yes, we do. I mean, I wouldn't say we're going to be your one-stop shop for everything, but we're focused post-transaction would normally be the kind of transition planning, helping you take a business, from that founder family-owned company that maybe doesn't have a real accounting or finance function, into the next stage and helping professionalize it, and then it'd help you find your permanent CFO or controller.
Great. Hey, Chris, everybody saying thank you. We appreciate your time and for you clearing a lot of doubts for people. We're going to be dropping your contact for a private group. The people who are serious, essentially, they'll be reaching out to you. Other than that, I appreciate it.
Awesome. Thanks, y'all.
Take care.
Glad to have you, Chris. Appreciate it.
You too. Take it easy.
Hey guys, #1 M&A group, page, channel in the world. We got no competition. We dominate. Who else is doing this? Drop a name. I'll go tell them what's up. Nobody, just us. Hey, #1. Everybody else, they're copycats. We set trends. We don't follow trends. Straight up. Everybody, comment billionaire. You already know how it is. Take care. Bye.
Yeah, we have a guest coming on tomorrow. So
we have a guest coming on tomorrow as well. Solid dude. We call him the money man. Jordan already knows. Take care, guys. Billionaire acquisition mastermind, not poverty stricken mastermind.